Corporate Finance Excel Practice Problem. In this presentation, we're going to work a practice problem in Excel related to level production versus seasonal production. Get ready, it's time to take your chance with Corporate Finance. Here we are in Excel. We have the information on the left-hand side. We're going to put that into the blue area into our worksheet on the right-hand side. We have the unit sales being October, November, December, and January. You can see that it spikes here in December. So we have this spike that is happening in December. So we have a seasonal type of business, and they're lesser of sales in October and November. So then we want to think about, well, how are we going to be purchasing or producing the inventory? Do we want to produce the inventory so they exactly line up to our seasonal type of business, which could result in less inventory on hand and less loan related to the purchasing of the materials or the inventory? Or do we want to have more of a cushion at the end, producing our inventory in a more even way, which will make the inventory production a bit easier for us to produce because we can produce it evenly or purchase it evenly, and it will also result in a cushion at the end of the time period. Now with the loan related to this, what we're going to say is that we're going to take out a loan in order to purchase or buy or make the inventory. And if we pay back the loan in the same month, then we're not going to be charged the interest for it. If we don't pay back the loan balance, then we're going to be charged interest on it. So we can think of it as basically a line of credit, that type of loan that we're going to be financing on the inventory. Now there's a couple different options that companies will take for this. So if you're in the type of business where you can do like a just-in-time type of inventory, if you're connected to your supplier very closely and you can take the order and then purchase the inventory very quickly, then you can limit the amount of inventory that you can have on hand. But if you have to produce the inventory, or if it takes some more time to get the inventory in stock to make a sale, then you're going to want to have probably some more cushion of ending inventory, or you're more likely to want to have a cushion. So that's going to be one of the factors involved with a decision like this. Also, if you're producing the inventory, you probably would like a more even production process, because if you're paying people to produce the inventory, then it could be easier for that production. Or if you're making the inventory, it would be easier for the production process if you can do the same amount of units each month rather than kind of spiking the production process in one particular month. So there's going to be pros and cons to either method, whether you're going to try to line up the purchase to line up directly with the seasonal business, or if you want to have some inventory outstanding. Obviously, if you have some inventory outstanding, it adds to the cost, but it also makes it more likely that you'll be able to meet the sales if there's some kind of difference within your projections. So we're going to assume the use of seasonal production will result in inventory directly matching sales each month, resulting in no inventory buildup. So if we were to line it up perfectly in seasonal production, then we'd have no ending inventory, and that would be it. But if we have level production, in other words, we're going to basically produce levelly over the 4-month time period to make what we think is going to be the estimated 15,900 units, even though there's going to be a difference in the months that we will produce them. We are less likely to run out of inventory, but we'll have an inventory buildup if we do that, resulting in loan costs and inventory storage costs. What is ending inventory for each month? Inventory cost per unit is going to be $5. Purchase of inventory is financed with a line of credit. The loan will be paid back with the sales each month. The outstanding balance will be the result of unsold inventory. The interest rate is going to be 14%. So once again, we're taking out a loan. We're going to be producing the inventory or buying the inventory, selling the inventory in the same month. If we sell it in the same month, we're going to say that we don't have any interest charged on it. But if we do not pay back the loan in that month because we didn't sell in that month, then we're going to have to pay back the interest at a rate of the 14%. Okay, so let's see what this will look like. I'm going to say, and also note we have 2 tabs here. Second tab, similar problem, so we'll go through this basically 2 times, a little bit faster on the second tab. Same format, just different numbers in essence. So we're going to say this is going to be equal to the October numbers. I'm going to copy that down then. I'm going to put my cursor on autofill and drag that on down. And there we go from October to January. I'm going to say this is going to be equal to the amount, the 2,000. And then once again, we will autofill that on down, putting our cursor on the fill handle and dragging that down. And there we have that. So that's picking up all of our numbers. If I double click on it, there's the 5,000. So then we're going to take the units that we're going to produce. Now we're going to assume this is going to be the flat method that we're going to produce. So we're not going to produce, exactly each month. We're going to take, hey, there's a projection for this 4-month time period of 15,900 units. I'm going to produce evenly that 15,900 units, even though the projection is going to be just different for each month. So we're going to say, okay, we're going to make the production an easy process, and we want to just make sure that we produce this many units each month. So that's going to be then the 15,900 divided by 4 months. And so there's a couple ways you can drag this on down in Excel. You could double click on it. You can make this an absolute reference by saying F4, and then you could drag it down, and that will then keep this cell the same. Or if you want, oftentimes I will just go to the next cell and say this will equal the one above it, and then drag that down or autofill that down. And that means every cell equals the one above it. So if you change the first one, it'll still change. So absolute reference is probably better, but I typically do that, equals method quite often. So then we're going to say the change in the inventory. So that means that the units sold here are going to be the 2,000 units sold. Let's do the units produced minus the units sold. The units produced minus the units sold. That means that we're going to have ending inventory of the 1,975. If I take that all the way down, there's going to be our change, right? So this is the amount of overproduction in October, the amount of overproduction in November, the amount of underproduction in December, the amount of underproduction in January. So then I want to figure out what ending inventory is. In the first month, it's going to simply be equal to October if that's our first month that we've done this for. In the second month, and this is a really useful formula, this is like a running balance type of formula. So it's really useful to pick this type of formula up. It's going to be equal to the prior balance plus the change. So the one up top plus the change, and enter. So you could do that all the way down. I could say equal to the prior balance plus the change, and then equal to the prior balance plus the change. Now you can copy that formula down, however, too. So I'm going to delete these to show that. I'm going to delete these. And I got to do it to the first cell. I can't copy this one down because it's not taking the prior cell. I could take the prior cell. I mean, you could, even though there's a word here that might not throw it in. No, it doesn't like the value. So you can't do that. But, so I have to do it one more time. This equals the cell above it plus the cell to the left. Then I can copy these down, because when I copy it down, these two cells will remove in relation to this cell. So it'll all move down, no absolute reference needed. We just autofill that on down, and then I double check it. So it's a little kind of confusing of a formula, but that kind of running balance, really, really handy formula. So that means that here, of course, we had the prior balance plus the new change. Then we had the prior balance, and now we had the decrease or the underproduction in this month. But that's okay because we had the beginning inventory to cover it. So now we're okay there, and we have an excess of ending inventory 1,025. And then in January we pay off we then have a difference of a 125 shortage that brings us back down to 0. So notice we're still at 0 at the end of the day, but we resulted in this kind of cushion here on the non-production months, and it also allowed us to produce more evenly over the 4-month time period. So if you don't produce evenly and you're making the inventory, then you're either going to work hard, yourself during those months, or possibly have to pay overtime and whatnot to crank out the high months in an attempt to try to make inventory to meet the months, as opposed to just making even inventory over the time period. Still results at 0, but you have these ending inventory resulting from it. Now, if we were then to think about the loans, we're going to say, okay, what's going to happen if we have to finance the production of this inventory? Let's do that. We're going to say this is going to be equal to, I'm just going to pick up the same months, and I'm going to copy that down. I'm going to autofill that down. And this is going to be the loan calculation. So I'm going to take the ending inventory. This is the amount that we didn't pay back. So we're going to say, hey, well, look, we took a line of credit to purchase the 2,000 of inventory, and then we paid it back, right? We paid back what we have, and we didn't pay off the amount that's still in ending inventory because we didn't sell those. And that's the amount that we're going to be paying the interest on. So we're going to say, all right, the ending inventory still has 1,975 left. The cost Now the cost per unit is $5. So what we're going to take is that ending inventory and multiply it times the $5. So I'm going to say this is the ending inventory times $5. So that's going to be the total cost of the inventory that we financed that we have not yet sold back. And so therefore we have not yet sold, so we couldn't pay back the loan. So we're going to be paying interest on that $9,875 portion. So then we're going to say, all right, then the interest rate is going to be 14%. Now notice that 14% is a yearly rate though. So whenever we see interest rates, it's always per year. Whenever you hear someone say this is the interest rate, unless they specify per month, it's per year. So the monthly rate would be that 14 divided by 12. Or we can think about it this way. I'm going to say, here's the balance now times the 14%. That's how much we would pay if it were a year. I'm going to take that and break it down to a monthly portion, dividing it by 12. So I'm going to take that and divide it by 12. And so there's the 115. Now you can think of it as the interest rate being divided by 12, or you can calculate the balance as if it's a yearly balance and then divide it by 12. It can be useful to think about that, either way. In other words, you can calculate this with the trusty giant calculator as the 9875 times 0.14, and then you say that's per year, and then divide it by 12, or, and note there is rounding here, of course, or you can take the 0.14 divided by 12 and say that's now the monthly rate. We don't usually talk about rates in monthly terms because see how small that is? It's difficult for us to talk about monthly rates. It's easier to go to the yearly rate because that's, usually a higher, a rate between, a higher rate. So if I take that and multiply it times the 9875, you're going to get to that same number. It's useful to think about the monthly rate with regards to formulas oftentimes, so it's useful to know that. Okay, and then we're going to say the ending inventory here for the next month is going to be equal to the 2950 that's still outstanding. The cost is going to be equal to that amount times the $5. So that's the outstanding amount that we haven't paid back in November. So that's the outstanding amount we're going to be paying interest on. So that's going to be the 14,750 times the interest rate, which is going to be the 14% divided by 12 to bring it down to a monthly total. And then we're going to say December is going to be equal to the 1,025. The cost is going to be equal to that number times the $5. And then the financing is going to be equal to the ending inventory times the 14% and then divided by 12. And then finally we have January here. January is going to be the ending inventory in January is going to be 0. So obviously we have the cost is 0 times times the 5 unit, or the inventory cost per unit. And this would be then the 0 times the 14% divided by 12, which is 0. Now you could also do this with formulas, so I wanted to do them one at a time just so you could see the calculation. But if I was to delete this and try to drag this down, the inventory, there's nothing I need to do there. I'm going to drag it down and it should pick up what we want. So I'm simply going to autofill that on down. The cost, if I take a look at that, it's going to be this times the 5 here. That $5, I don't want that to move when I drag it down. So I'm going to absolute reference it by putting my cursor between the B20 and saying F4 in there, $sign before the B and the 20. Then put my cursor back on it, use the fill handle and autofill that down. And we should have the absolute reference. I'll double click on this one to see if it does what we want. It does. Totally did what I wanted it to do, so that's good. So then the financing is going to be this cell times the 14% divided by 12. This 14%, we want that to be absolute reference because I don't want it to move. So I'm going to put my cursor in B26 and select F4. Now the 12 is hard-coded, so it's going to stay what it is, hopefully. So I'll take that and I'm going to drag that on down with the autofill. Double click on here to see if it does what we expected it to do. It did what we expected. And so I'm then going to go up top, Home tab, Font Group, and underline here. And then we'll go to the total. Let's total this thing up. We don't need to total the ending inventory. That doesn't make sense. The total, we can total the cost. Now let's just total the financing charges. So this is going to be the total financing over the period, then summing this up, trusty sum formula, our most famous and fun formula, and that's going to be the 347 related to the financing. So obviously we would have the financing here. If we were to seasonally produce, we wouldn't have the financing charge because we would be able to meet exactly the inventory and pay back any financing within the same month. And if we were able to do that and not get charged by paying it back in the same month, we would be good. Okay, so then let's go to the second item. Same kind of scenario, just different numbers here. Let's do it a bit quicker. So we got the units this time for March, April, May, and June. So you can see now May is our big month, seasonal production. Same kind of process. We're going to say, okay, how are we going to make the inventory? You know, we got this 4 month that we're planning out for. We think May is going to be huge, but we can either try to produce our inventory to meet this exactly, which means we can take out a loan for the production or purchase of the material, and then we can pay it back in the same time period and hopefully not be charged the interest on it, or we can we can have an even production over the total 4 month period, which will make the production process easier, so we don't have to maybe pay overtime to produce or go crazy when we're trying to produce in May. Have a nice even 4 month production, but then we're going to have to finance the production over that 4 month time period, resulting in ending inventory, making it more likely that we won't have sales that we can't meet. Hopefully, right, we'll be able to meet the sales more likely with the ending inventory, but we will have to pay financing charges for any ending inventory because we didn't sell it and therefore aren't going to be paying back the loan related to the ending inventory. That's the scenario. Okay, so I won't read through it again. Same kind of concept. The interest rate now is going to be the 8%. The cost of our units are going to be $12. All right, let's do this again. We're going to say this is going to be equal then to pick up the months. This will be equal to March. Now this time I'm going to copy and paste it down. So I'm going to say Control C, down arrow, holding down Shift, down, down, Control V. So copying and pasting. Then we'll pick up the units sold, this being equal to the 3,000. I'm going to go back on it, do the copy and paste, Control C, down arrow, holding down Shift, down, down, and Control V. I missed the V. Let's do it in Control C, down, Shift, down, down, Control V. So there we have that. It's picking up what we want. That looks good. Then we want the units produced. I'm not going to try to produce them seasonally. We're going to then say we think that 31,300 total will need to be produced over 4 months. Let's produce them evenly over the 4 months and have a nice even production process instead of going crazy in like May. So we're going to then take the 31,300 divided by 4 months. Now, I'm going to copy that down. You could do that a couple different ways. You can make this an absolute reference, F4, and then Control C and paste it down. Or I'm going to say Control Z, undo, Control Z. Or sometimes I just say equals the one above it. And then I can Control C, down arrow, hold down Shift, down arrow, Control V, and paste that little formula down, and it'll always equal the one above it. So that's probably not the best way, but again, I do that quite often, so just so you know. So then we got the 7825 minus the units sold. So that means that we produced 7825, and that means we overproduced 4,825 in March. In April, we got the 7825 minus the 7500. We overproduced 325. And then in May, we produced 7825, but we sold 11.3, so we underproduced, but that's okay because we'll have beginning inventory there. And then in June, we once again we didn't produce enough, but we had beginning inventory. So now we'll calculate the ending inventory in the first month of production. It is what it is at the end of that month. Then we have the beginning inventory, so up 1, the prior beginning inventory plus the change, so the increase in this case, and that's going to give us the ending inventory. So now in May we had beginning inventory of 5,150 plus the decline. This is going to be plus a negative number, which is going to take it down, and that brings it down to the 1675. And then in June we had beginning inventory of 1675. We had a decrease because we didn't produce. We produced 1675 not enough, and therefore that's okay because we have beginning inventory. That brings us back down to 0. Once again, this is a really nice formula. I'm going to delete these to learn, because this is like a running balance formula used quite often. So once again, it's going to be the one above it plus the one to the left of it, and then you can simply Control C, down arrow, Shift down, Control V, copy and paste it on down, and it'll do that nice little running balance all the way down. So we're back to 0 at the end of the day, but we have these outstanding inventory balances as we go. The production total is correct. We produced exactly what we needed, but we did it evenly, and that resulted in these ending balances for which we will have to make some payments on. So let's do that. We're now going to say that this is going to be equal to the same months. I'm going to say Control C, down, hold down Shift, down, down, Control V, pasting those out. The ending inventory, I'm going to pick up the ending inventory. This is going to be equal to the ending inventory up top. I'm going to do the same thing, Control C, down arrow, holding down Shift, down, down, Control V, pasting that out. And then we're going to pick up the cost, which is going to be the ending inventory times the cost per unit. So it's going to be equal to the ending inventory times the cost per unit. So that's how much it cost us to make these ending inventory units, which we have not yet repaid yet, right? We financed them. We haven't repaid, and therefore we're going to have to charge interest on it. Now, I want to drag that down, but I don't want to move this 12 number, which is in cell B20. So I'm going to put my cursor in B20. I'm going to select F4 on the keyboard, put in a $sign before the B and 20, and then put my cursor back on it and autofill that down. So there we have that. I'll double click down here to see if it does what we expect. It does, so that's good. And then we're going to go to the financing then. The financing is going to be equal to the outstanding balance that we didn't pay back times the 8%. Now that would be for a year, remember. So if I was to leave it like that, that'd be the interest rate per year. But we're only in a month right now, so I'm going to take that and divide it by 12. I'm going to take that, I'm going to divide it by 12. It's 12 months, monthly. That's going to be the 386. Now I want to copy that down, but if I double click on it, this one will move down the way I want. This one will not. So I'm going to take that one. I'm going to absolute reference B26, putting my cursor within B26, F4, $sign before the B and 26, put my cursor back on it, Control C, copying it, down arrow, holding down Shift, down, down, Control V, pasting that on down. So there's going to be our financing charges. We're going to then say the total. Let's sum this up. We're just going to sum up the financing equals the sum of trusty sum formula, our favorite formula, most common formula by far, most useful formula, and we'll put an underline there, and there we have it. There's our financing.